A financial tremor has just been recorded. Its epicenter is not on any geological fault line. It is in the heart of the global monetary system. And the initial shockwave is beginning to spread. This is not a minor adjustment. It is not a simple policy tweak. This is a signal. A clear, deliberate, and potentially devastating signal that one of the world's cornerstone financial institutions is preparing for a collapse, that mainstream analysts are refusing to name. The rules of the global economy are being rewritten in real time, and what happens next will redefine power, wealth, and security for the next generation. Stay with me, because what you are about to see is the blueprint for the coming financial earthquake. You are about to understand the true scale of a decision made behind closed doors, a decision that goes far beyond balance sheets and interest rates. Most news outlets will report the surface level facts. A meeting concluded. A statement released. A minor shift in policy language. But they will miss the story completely. Because beneath that calm surface, a tectonic plate in the global financial system has just slipped. The foundation of modern trade, the bedrock of trillions in investment, is now showing a hairline fracture, and that fracture is spreading faster than anyone in power will admit. In this video, we will connect the dots that the financial media ignores. You will see how a single, technical announcement from a key European financial authority is not an isolated event. It is a distress flare. You will learn why this move exposes the fatal weakness in the Western financial alliance. You will discover the chain reaction it has already triggered in Asian markets, in Middle Eastern sovereign wealth funds, and in the strategic calculations of nations positioned to exploit this moment of vulnerability. This is about more than money. This is about the imminent unraveling of a decades-old monetary order and the violent scramble for what comes next. By the end, you will understand why this week may be remembered as the point of no return. Before we see the explosion, we must locate the spark. The catalyst was not a market crash or a bank failure, it was a document. A dry, densely worded regulatory memo from the European Central Bank concerning its contingency plans for extreme financial stress scenarios. Buried on page 47 was a single unprecedented clause. It outlined a provisional framework for member banks to temporarily suspend the settlement of transactions in a specific foreign currency in the event of a sustained loss of correspondent banking access. The language was bureaucratic. The intent was revolutionary. For the first time, a major Western central bank had formally drafted a plan to functionally cut off a part of the global dollar system. The target currency was not named, but the implication was unambiguous. This was a war game scenario for a financial blockade. The message was not sent to markets. It was sent to foreign treasuries and rival central banks. It said in the clearest possible terms, we are preparing for the dollar to become a weapon. And we are building our bunker. The immediate reaction was not panic in New York or London. It was a chilling, calculated silence in the capitals of nations long seeking an alternative to dollar dominance. Then the moves began, not with speeches, but with actions. Sovereign funds in the Gulf, previously steady buyers of U.S. Treasury debt, paused their automated purchasing programs. Not a sell-off, but a freeze. Awaiting. In Singapore and Shanghai, currency swap lines that had lain dormant for months were suddenly quietly reactivated. The financial intelligence networks of the world lit up. The memo was a key turning in a lock. And on the other side of the door was a new and far more dangerous financial reality. This move did not happen in a vacuum. It is the product of a slow-burning crisis that has pushed the European financial system to its breaking point. For years, the ECB has been engaged in a desperate balancing act, managing unsustainable sovereign debt levels in Southern Europe, combating recessionary pressures in Germany, and trying to maintain a coherent monetary policy for 20 different economies. The strain is visible. Growth has flatlined. Energy dependency has created permanent inflation pressure. Political fragmentation is making unified action almost impossible. The European project is facing an existential economic threat, and its leaders are now gaming out their last lines of defense. The memo is a confession of profound systemic fear. It reveals that the guardians of the euro are no longer confident in the stability of the very system they helped build. They are preparing for a storm they see forming on the horizon, and that preparation in itself is now becoming the storm. To understand why this technical memo is a seismic event, you must see the landscape it was dropped into. Europe's economy is a paradox of immense wealth, sitting atop a foundation of sand. Its banking system, particularly in its core nations, is grotesquely overexposed to a single colossal risk, the unraveling of the global debt cycle. European banks hold trillions in derivatives, sovereign bonds, and corporate debt that are all priced for a world of perpetual stability and endless central bank support. That world is ending. The trigger for Europe's fragility is not internal. It is external. For decades, European prosperity was built on a triad of reliable imports: cheap Russian energy, massive Chinese consumer demand for German machinery and French luxury goods, and unfettered access to dollar-based capital markets. That triad has shattered. The energy shock is permanent. The Chinese economic model is pivoting inward, slamming the door on export growth. And now, the final pillar, the dollar system, is being visibly questioned by Europe's own central bankers. The continent is entering a triple crisis of supply, demand, and financial confidence simultaneously. The ECB contingency plan is the first official acknowledgement that the center cannot hold. The leadership knows the existing playbook is obsolete. Their new strategy is no longer about managing growth. It is about managing collapse. This shift from manager to prepper is the single most important economic signal of the decade, and it has just been broadcast to the world. The chain reaction began not with a bang, but with a series of calibrated, silent withdrawals. The first domino fell in Asia. Japan's Ministry of Finance, the world's most disciplined and conservative financial actor, made an unannounced adjustment to its foreign exchange reserves portfolio. It didn't sell dollars. It simply allowed a larger than usual portion of its maturing U.S. Treasury holdings to roll off without reinvestment, funneling the capital instead into short-term German and French sovereign paper. And, significantly, a small increase in gold allocations. This was not an attack. It was a hedge. A quiet, devastating vote of no confidence from America's most loyal Pacific ally. Japan was reading the ECB memo and positioning its lifeboats. The second reaction was swifter and sharper. In Beijing, the state-owned banking giants received new, unpublished guidance. Overnight, the internal pricing for financing long-term import contracts in dollars became prohibitively expensive. The signal to Chinese corporations was clear. Begin diversifying your trade finance away from the greenback, accelerate the use of bilateral currency swaps, and prioritize settlement in yuan or commodities. This was the operationalization of financial decoupling. While diplomats spoke of engagement, treasurers were preparing for divorce. The global economy runs on trade credit. China was now rerouting its plumbing. Then, the volatility hit the heart of the system. The US dollar index, the DXY, began experiencing violent intraday swings unrelated to any U.S. economic data. The glue holding currency market stable, the assumption that all major players were aligned in supporting the system, was dissolving. The ECB Act of Contingency Planning had given legal and psychological permission for every other nation to do the same. The era of strategic financial unity was over. The era of every nation for itself had begun. The chain reaction is a feedback loop of fear. One institution's public preparation for crisis makes the crisis inevitable by triggering the very behaviors it fears. The consequences are moving from currency markets into the real world with frightening speed. The first casualty is global trade finance. Letters of credit, the essential documents that allow cargo ships to leave port, are now facing unprecedented delays. Banks in Europe and Asia, acting on the new risk scenario hinted at by the ECB, are subjecting dollar-denominated transactions to enhanced due diligence. This is banker code for freezing. A container of semiconductors from Taiwan to Rotterdam or Brazilian soybeans to Shanghai can now be held up, not by storms or pirates, but by a compliance officer in Frankfurt fearing a settlement freeze. Supply chains still fragile from past disruptions are seizing up at the financial level. This directly fuels the second consequence, a brutal new wave of inflation. When the flow of money slows, the flow of goods stops. Scarcity returns. The cost of moving physical items skyrockets as insurance premiums on shipped goods rise to reflect the new geopolitical risk surcharge. This is not demand pull inflation. This is system collapse inflation. It is immune to interest rate hikes. Central banks are fighting the last war while a new economic reality takes hold, one where money itself is no longer a reliable tool of exchange between rival blocs. The third and most dangerous consequence is the forced realignment of alliances. Nations with commodity wealth, the Gulf states, resource-rich African nations, and major agricultural exporters now hold unprecedented power. They are being courted not for military bases, but for trade agreements that bypass the dollar entirely. We are witnessing the birth of a new axis of influence, forged not by treaties, but by bilateral barter deals. Oil for drones, lithium for infrastructure, wheat for diplomatic recognition. The geopolitical map is being redrawn by supply chain managers and central bank governors, the West's primary tool of influence for 80 years. The control of the global financial system is blunting before our eyes. The immediate future will be defined by one word: fragmentation. We are not moving toward a single new reserve currency. We are hurtling toward a fractured world of competing financial zones, a digital yuan zone in Asia and parts of Africa, a diminished but still critical dollar zone in the Americas and among core allies, and a defensive, unstable eurozone trying to hold its periphery together. In the gaps between these zones will be volatility, arbitrage, and opportunity for ruthless actors. Watch for these key triggers in the coming weeks. First, a technical default or delayed payment by a major European nation on an energy bill priced in dollars, citing currency access issues. This will be the first test of the ECB contingency plan. Second, a coordinated announcement from several BRICS nations of a new shared collateral system for trade, completely separate from Western clearinghouses. Third, and most critically, a sudden, sharp drop in liquidity for U.S. Treasury bonds, manifesting as a failed auction. When the world's risk-free asset is no longer seen as safe or liquid, the final phase of the transition will begin. This is the financial equivalent of the Cuban Missile Crisis. We are in a slow-motion standoff where the weapons are Treasury bonds, the armies are algorithms, and the battlefield is the blockchain. The memo from the ECB was the moment the other side's preparations were spotted by satellite. There is no going back. The trust is gone. The system is now operating on a timer. What you do with this information is critical. This is not about fear. It is about awareness. You must watch the actions, not the words. Track capital flows, not political speeches. If you found this breakdown critical, make sure you are not left in the dark. Like this video, subscribe, and hit the notification bell. We are here to connect the dots others ignore. The story is accelerating by the hour. We will be here watching it unfold. The next move is coming, and it will change everything.